we're going to have a fantastic session from Matthew Lemerle. If you've not heard him before, you're going to be in for a treat. If you have heard him before, you're still going to be in for a treat because he is prolific, smart as hell, and you learn a lot from Matthew. So stay here and let's get into Matthew. Matthew, thank you so much for being here today. We appreciate your time. We appreciate you. And I'm so happy that you're able to share with us your knowledge.
Thanks a lot, Kareem. And I really appreciate, Kareem, that you have given me an exemption from the GIC format, because this is going to be not me talking. It will be me talking over, but this is going to be an old-fashioned PowerPoint presentation. And the reason for that is twofold. One is sometimes a picture can tell 1,000 words, and the other is I want to cover a lot of ground really, really fast. And for those of you who are interested, Kareem has these materials and we'll make them available to you. I don't believe that I'll need 45 minutes, but we'll see how it goes. And Kareem, I may well be able to hand you back some time. But let me just get this up on the screen. Can you see this page? Kareem, can you see that?
Yeah, Matthew, we can see it.
Yes. Yeah.
Very good, thank you. So what I'm going to talk about is I'm going to talk about digital monies, commodities and assets and why they're at this point inevitable. And the reason I'm doing that is because things such as crypto or NFTs are actually subcategories of something broader, which is this. All of the world's assets, all of the world's monies, all of the world's commodities are in the process of being digitalized, and that's also creating new to the world types of financial offerings, but it's also about the digitalization of the ones we already have. I'm not going to present who we are, other than to say that we're the world's leading fund of funds focused on blockchain, and we also have 2 direct investment vehicles. We manage about $450 million across 6 funds, and we are investors in the bottom right-hand corner in about 55% of all of the blockchain unicorns and crypto projects worth $1 billion and more, and most of that was captured in the early stages of investment. I do want to tell you that we are not traders. We don't do public liquid crypto assets. We don't invest in crypto hedge funds. We don't use leverage. And as people on this webinar know, I've been telling you for several years now that Alison and my view is you can't invest in things if you don't understand the counterparty risk, which is why we've never invested in yield management or interest generating products in crypto. And I know you've heard me say that in the past, but I think now you understand why we've been saying that. For us, this last year is obviously a dangerous time for investors. First bullet point, but it's about COVID, inflation, Russia and Ukraine, and the collapse of all investment classes. And then on top of all of that, we've got our public liquid crypto blizzard going on. And but this is a very difficult time in many respects for investors. The good news is, as I'll show you in a moment, and at the end of this presentation, downturns are great for early stage venture investors. They always are. And in our context, our funds are still the highest performing in the world in their category, and most of them are dry powder. The next few bullet points is what I'm about to show you. Our investment thesis for 10 years now has been that all of the world's digital monies, commodities and assets are being digitalized. It's inevitable. And in fact, we're now seeing an acceleration of that adoption. And what I'll also be telling you is that all of the world's financial infrastructure is going to have to be upgraded to support digital monies, commodities and assets. And that means everything. This is a true horizontal, because by definition, every business, every individual, every government, everyone and everything soon enough transacts. So as we upgrade to digital transaction and commercial infrastructure, everything has to change. And that is really a very big opportunity for investors. This is actually the page I want to start with, because most of the people on this call remember this quite well. It was called the dot-com boom and bust. And just to take your mind back, because we think there's a lot to be learned, especially if you're an investor. You'll recall that back in the early 90s, there was this thing called TCP/IP. It was giving rise to something called the internet, or the World Wide Web, as we called it then. And most people didn't know what it was, or how to use it, or why it was important. In fact, most of the world's largest companies said it was not useful and they didn't need it. By the mid-90s, we were beginning to see a few use cases. We were beginning to see more investment flow into the space. Alan Greenspan had lowered interest rates in the first half of the 90s. There was a lot of capital availability, and that capital was flowing into the stock market and into tech stocks. And he began to warn of irrational exuberance. And he did put up interest rates, but not that much. And as a result, by the end of the 90s, we had a boom marketplace. We had a public equities boom, and NASDAQ eventually went to an all-time high. We also saw it in the private markets, and private market valuations were also going up really, really fast, particularly if you said you were .com. By about 2000, we got overinflated, prices were too high, and we had a collapse. And you remember that even some of the most valuable companies in the world, like Cisco and Amazon, in retrospect, they were down 80%. From their peaks, sometimes more. And dot-coms that had been going public, if they could simply say they had a business plan and some revenue and some eyeballs, were suddenly going out of business, and the private investment market collapsed. Did innovation stop? Of course, innovation didn't stop. And in fact, today, we know that almost all of the world's most valuable companies are internet-based companies. So the innovation didn't stop. And furthermore, the investing in internet became the driver of alpha for all investors globally. It was the biggest single wealth creation opportunity for investors of our lifetime so far. And it drove the returns of even the world's oldest and most established investors. So if you look at Warren Buffett, most of Warren Buffett's alpha of the last 10 years is driven by one investment in Apple. And almost all of the other investments he's made have struggled to return alpha. So this is a global phenomena. It drove returns, certainly for the last 10 years. And once again, perhaps it ran ahead of itself. So what was really going on? What was really going on was that we were digitalizing communications and content. Communications and content. That's what the internet was designed to make easy, accessible, and real time. And that's what we did for at least 20 years, more like 30, in fact. We built out connectivity, accessibility, interactivity. The internet is reasonably flexible. It certainly scales pretty well. And it allows us to do what I'm doing right now, digital content sharing. It is really bad as a commerce platform. It's highly insecure. It has no system of identity and trust embedded in it, which is what we heard earlier on one of the earlier panels today. It has become increasingly concentrated, as several people have said today. And most important, it has no system of digital payments and assets embedded in it. In fact, when you buy something, say from Amazon, you tell them, you communicate and say, I want it. They communicate back, you can have it. You agree the price. You think you paid for it, but actually the payment goes out of payment gateway. It goes over old infrastructure, which is slow and costly, and in fact is not fit for purpose for a digital economy, because it can't support things like micropayments. So for us, the next 20 years is about the digitalization of commerce, communications, content, and now commerce. And that is essentially why everything we're talking about at this Global Investor Conference is so important. Now, as a proxy, we can look at crypto. But as I've already told you, for us, crypto is just a subcategory underneath digital monies, commodities, and assets. It's just one subcategory. But if you look at the adoption curves of crypto via the internet, and you look down this line, you can see that actually crypto adoption use curve is tracking ahead of the internet adoption use curve, which is quite remarkable. Why is it so? It's because we've already built out the internet. So because we already have digital communications and we already have digital content, digital commerce is coming next, and it's building on top of that global infrastructure. So it's actually seeing an accelerated adoption. And that's before I show you this page, because if you actually look at who uses crypto, it's the digital natives. So the pale blue, and I guess half of the dark blue, are digital natives. Digital natives, leading edge, 45 years old and younger, about half the world's population. They don't just use digital technology, they are reliant upon digital technology, and they expect to be able to conduct commerce, which means transactions, investments, insurance, and other financial products and activities. They want it to be as easy as sending an email or sharing some content. And so that is, and this is the biggest single tailwind. The reason we know the adoption curves are going to continue to go up on everything we're talking about, regardless of regulation and hiccups in the road like major frauds, the reality is the adoption curve's going up because these people are aging. They're actually coming into their peak earning years, their peak investing years, and they are the future. So this is inevitable, and that's why these curves are going up. So this is, we do a biannual report on the blockchain unicorns. You can download and read it. We are now at an all-time high. Blockchain enterprise unicorns are at an all-time high. Yes, the rate of formation came down a little bit in the last 6 months, but we see this adoption curve continuing to rise. Yes, there'll be down rounds. Yes, some companies will drop off the lists, but more are coming behind them. So what is the reason that digital monies, commodities, and assets are valuable and useful? And the reason is because legacy finance is broken. That is the issue. Legacy finance is broken. It came out of the 1970s and 80s. It was mainframe based. It was version 1 technology. And that is the curse for the financial services industry. They digitalized early, which means that all of their activity rests on very old generation 1 technology. And even though they've worked to make it better, now it's stuck together with sticky tape and string. It is broken. It is unable to upgrade in many cases. It can't support things, as I've already mentioned, like micropayments. It's not fit for a digital age. We know it's inefficient. We know that settlement is slow. Oftentimes, human capital is required to get in the middle of a transaction. Sometimes, believe it or not, faxes are required to get in the middle of a transaction. What's a fax, you may ask? It's what they rely upon. The costs are high, and I'll show you some examples. It's not borderless, it's not 24/7, it's not accessible to most of the world, and that's a surprise, but actually most of the world's 8 billion people can't even access most of the infrastructure that currently exists. And as we've demonstrated time after time, counterparty risk is enormous given those inefficiencies. About 40% of all of the world's banking costs are used up by KYC, AML, credit and risk. And all of that is because of counterparty risk, because they don't have high quality, real-time, efficient ways of knowing what they're doing. And by the way, the regulators also don't have real-time ways to do compliance. They have to do rear view mirror forensic compliance, which takes 2, 3, 5 months to figure out what happened in the past. We still don't really know what went on with GameStop at the beginning of this year. So a couple of examples. This is one you'll all be familiar with. We've all got bank accounts. This happens to be a Chase account. I'm not picking on Chase. I could have picked any of the major banks. If you want to send an international remittance, you will be charged probably $25, even if it were just $100 that you're sending to a family member abroad. The other part of it, though, is there's an incoming wire fee. If you are abroad in London and you're studying and your parent sends you $100, they're getting deducted a wire fee. you're getting an incoming wire fee too. It's slow. Oftentimes it relies upon SWIFT, which is a fax-based system, as I think I mentioned. And you're going to get a physical call before your bank will send the money abroad. And that is what the state of art. That is actually the state of art. Slow, costly, inefficient, broken. It gets worse because that's the US to UK international remittance pipeline. By the time you go off the major pipeline, railway, if you go off the major rails, it gets even worse. The banks will proudly tell you that the global average cost of international remittances is 6%. But that is very misleading. It is misleading both because in some countries, the numbers are much, much higher, and I'm just using an African example here. The other reason it's very, very misleading is because some people are sending $100 million at 6%, and some people are sending $100 and being charged 40%. And so the averages lie. It's much, much worse than the averages say. So that's why stable coins are taking off so quickly. Stable coins, as you all are familiar with, are things like Tether and Circle, but those are just proof cases. They are simply prototypes. They are proof cases. They happen to be very large, and they're already demonstrating use cases and value and validity. We're in a battle now about who gets to issue stable coins under what compliance and regulatory environments, but they're not going to go away. They're not going to go away because they are superior products. They are superior products for international and domestic payments. And so eventually, all of the world's banks will want to have them and issue them, and all of the world's payment companies too. And that is why this is no longer a question of will we have stable coins. They shouldn't actually be called stable coins, as Greg always says. They're actually just digital monies. We will have them. It's inevitable. And the debate is over who gets to issue them and who gets to manage them. These are the curves of usage. Yes, it's come down a little bit recently over the course of this summer, but that is an absolutely phenomenal adoption curve on any new technology, let alone a financial product. So there are clear improvements to the existing legacy situation. I won't go through them. I've said most of them. They're pretty straightforward. And the world knows it. It's one of the biggest opportunities in the world because we all transact all the time. So because we all transact and all of that's going to a new higher quality version of digital technology, then everything and all of the infrastructure has been upgraded. And we're beginning to see all of the big players agree. I'm starting off here with MasterCard and Visa. They both announced that this is the future, it's going to happen, and all of the other payment companies know it's going to happen too. Now let's turn to assets. And in fact, the world's biggest banks are all investing into the space. Let's just talk for a minute about assets. I'm going to skip commodities, but everything I just said is true for commodities too. And for many commodities, they're still paper-based. If you want to buy and sell coffee, if you want to buy a carbon credit, you're going to have to do it on paper, at least today. And that is all going to be digitalized. But now let's talk about other types of assets. And here I'm talking about public equities, private equities, funds, real estate. You know how it works. We just talked about that with Bill. The way it used to work, you want to buy something, you go to a brokerage firm, they have to do a bunch of work to figure out who you are and whether or not this should be allowed, you should be allowed to buy it. Eventually a trade gets sent and executed and you'll get some electronic confirmation if it's something like a public equity. And even that will take time, 2-3 days to get the settlement done. That is state of the art. By the time you get to most of the world's assets, so most of the world's real estate, most of the world's funds, most of the world's private investments, they're still paper-based. It can take you 30, 40, 50 days to complete the transaction. And if you think I'm exaggerating, that's how long it takes to do a retail a residential real estate transaction, 45 to 90 days for something that is ubiquitous and we all buy and sell because we all own homes. We don't all own homes, but even if you wanted to lease a house, it's going to take you a little bit of while. So again, blockchain is enabling the tokenization, we call it tokenization, but just think of it as being digitalization of the ownership certificate for an asset. Everything in the world can be thought of as an asset. All assets conceptually could have an owner or a group of owners, and then you would need a title. You would need to be able to demonstrate that you own that asset. Almost all of the world's certificates of ownership or titles are paper-based. All of them are going to be digitalized. So it doesn't matter if we're talking about a home, a piece of art, a fund from KKR, or for that matter, a piece of digital art, or even a right to something. It can all have a digital ownership certificate. And then under that, we have subcategories. Is it fungible or non-fungible? What category of asset are we digitalizing? All of that is in process. All of that is in play. So there are benefits. I won't go through them. I think they're pretty obvious: cheaper, faster, more secure, transparent, better compliance, better security, if done right. If done wrong, well, that is an issue, right? Because digitalization is a double-edged sword. You can use technology to scale up good things, and unfortunately, bad people can use technology to scale up bad practices. And we saw that in the 90s. You experienced it. Porn became ubiquitous because it was digitally enabled. That would be an example of something that some people think is a bad good, that technology powered up and enabled, and now it is ubiquitous, free, low cost, easy to access, and some people regret that. So this is a double-edged sword. And so scammers, such as the people that we don't name anymore, those people use technology to scale up their bad practices, and that is deplorable. This is a massive opportunity too. This is BCG, the Boston Consulting Group, just laying out their predictions for which categories will digitalize first. It is a very big thing. Again, announcements and momentum. In terms, there's two major things that institutions have to do to get institutional digital assets to the marketplace. They have to first enable digital asset custody, because otherwise, if they issue them, you can't hold them. So that's why announcements like BNY Mellon and BlackRock are so important. And then they actually have to enable digital asset issuance. And that's why the announcements of things like KKR and Hamilton Lane as examples are very, very important. That all of the world's biggest asset managers are now digitalizing some of their products, bringing them to market, but they need to ride on new infrastructure in order to do that. If you ask them, is this going to happen? They all answer yes. And that is important too. So I'm going to now bring that segment to a close, because that is our investment thesis. I've just shared with you our investment thesis. It's an investment thesis that we told you, some of you, the Kretsu members, we told you about this 10 years ago. Alice and I wrote a book several years ago about this, and it's pretty straightforward. The internet digitalized all of the world's communications and content. You know it, you live through it, you use it. It was the greatest value creation event the world has ever seen so far. However, monies, commodities, and assets are not yet digital. Most of them are still paper-based, or they're riding on first-generation technology. And that means we can't get to a global digital economy. Therefore, humankind must digitalize commerce too. And they will. And all of the world's financial infrastructure will be upgraded. And since businesses, individuals, and governments all transact all of the time, and we're now turning on devices and the Internet of Things so that devices will be transacting all the time, this will be the greatest value creation for the rest of your lives. Now, there are others. We also believe that personalized medicine, we also believe that moving out of the carbon economy into a clean, sustainable energy environment, these things will be big value creation events too. But this is the big one. This is the big one of the rest of our lives. So if that's our investment thesis, where are we right now? And I'm just going to close out, Karim, with these last few slides. Where are we right now? Of course, we're in the middle of a crypto winter. We all know that. Why are we in a crypto winter? Because some of this is experimental technology, and the experimental technology got pushed into the public markets early. And issues like counterparty risk were not well understood. And then there were bad actors and bad practices, and that's all deplorable. Have we seen it before? We have. In terms of FTX specifically, I won't go through this page. You can read it later. We have a little bit of a point of view about why this is going to be impactful over the medium term. We're not happy about it. But then we remember 2001 in the dot-com crash. There were bad people, bad actors, bad things happened. We didn't stop innovating. We innovated through those bad times. The rest is history. That's what's going to happen this time too. And that's why I'm repeating this page. You lived through this cycle before. You already know what's going to happen next. And you know that the world's most successful investors of the dot-com crash and of the zeros were the people that stuck the course. They were called Sequoia, NEA, and they carried on doing what they were doing, and they became the highest returning funds in the world. And that's what's going to happen again. And then if you want to see the evidence of why what I'm saying is absolutely inevitable and true, this is every recession of your lifetimes and beyond. And you can see how long the recessions were, and you can see what sort of returns you would have got if you had placed capital 6 and 12 months before the depth of the recession, and conversely, what returns you would have got if you'd placed capital 6 months, 12 months, and 2 years after the depth of the recession. And this page, which is about public equities, is obvious. You get the highest possible returns if you buy low and sell high. And when do you get to buy low? After the depth of a recession. So the people that allocated capital in the 2 years after the depth of the recession got superior returns. It's sort of obvious. Well, it happens to be true in private equities as well. These are the cohort returns for private equities in America every year for the last 30 years or so. And what you see is the cohort returns are highest for the funds created in the 2 or 3 years after the depth of a recession. So having dry powder and investing into a downturn gets you superior returns if you're a private equity investor. Why? Because the valuations go down. Now, it's a bit more subtle than that. The competition also gets reduced for the companies you back. And eventually, when the large companies roar back and want to get back on their growth trajectories, they have to buy companies to help them in the process. And that creates a very vibrant exit market 3 and 4 years later. So it's a bit more simple, more complex than just the valuations of early stage go down, but the valuations of early stage do go down. Late stage is even more volatile. So we think it's the ideal time for all of you. It's the ideal time for all of you for all the reasons I've just said. Digital monies, commodities, and assets are inevitable. Many of the leaders are on the Linqto platform today. It's going to be powered by the digital natives, and there is no stopping that. They are the future, and this is what they want. The downturns are going to wash away lots of FOMO and opportunists. We saw that 2001. We saw that 2009. We're happy about that. Those people that show up with Wall Street with billions of dollars and throw it at companies at multi-billion-dollar valuations temporarily appear to help us, but in the long term, they really don't. They don't help us because we have to pay more for when we invest, and also because they sometimes create these irrational exuberance phases, and I believe we just had one of those. The superior returns in venture are always highest following downturns. I showed you that evidence. There are selective distressed opportunities. Some of those may show up on Linqto if Joe can get some good deals. We only do this very, very selectively. We're not late stage investors. Our goal is to get into all the best companies in the early stage. But we do understand that distressed late stage can be very exciting for some people as well. And then that last point is much more important than it may at first glance appear to be. Most of the world's capital is being invested by professional managers, and most of them struggle to get any type of positive return. Almost all the world's hedge funds destroy value on average. And in fact, most pension funds have had great difficulty in getting a positive return for their investors. So they need growth. They need alpha. And over the last 10 years, I already said that was the FANG mega trend. But that's coming to an end. Maybe it will carry on a little bit. Right now, there may be a buying opportunity on Apple, Amazon, and so on, but it won't go on forever. The next big mega trend for those investors where they will need to allocate their capital is the one I'm talking about. It is the complementary theme to the internet. We've digitalized communications and content. We're digitalizing commerce now. And that's really it, Karim. If anyone wants to contact us, we're easy to find. I'm happy to take questions if you think we have time. And conversely, we can give back some time if you prefer. And Karim, I hope you haven't gone for lunch.
I haven't gone for lunch, but I've been thinking about it. No, that was great. We have time for questions for sure. Our next panel is not scheduled for another 10 minutes, 5 minutes, 7 minutes. But if there are any questions out there, this is fascinating to me. Matthew, the first thing that occurs to me is this. As we wait for more questions, we've had a lot of investors and some of them may have invested into the public equities market, into the FANG arena, Facebook, Apple, Amazon, et cetera, got caught, continued to invest on the up cycle, got caught, didn't want to get out because what's the point of getting out when the stock is going down? You've got a whole bunch of assets now that are depreciated. We talk about the changing trend. How then would these investors reallocate their funds from that point of view?
Well, so there's a whole theory in finance around that, and because most of us, it's proven to be exceptionally hard to call the top of a market, and of course, if you could time the market, you would earn superior returns. But it turns out almost no one ever can demonstrate that they can. In a minute, and this summer, we've seen all these articles about people that said, I told you so, and I put my money where my mouth is, and that's why I have a high return. And that may be true, but all of the academic research demonstrates that three monkeys throwing darts at a dartboard get it as just as right. So there is some probability distribution that says some people will time markets. On average, we can't. So that leads to the notion of dollar cost averaging. All investors should dollar cost average. And that does mean that sometimes we're putting money into rising markets. Sometimes we will have put in money at the peak of a market. And sometimes we'll be putting money into a downturn. If you're clever, you will heavy weight during the downturns and you will lighten up in the high years. So that's what your theory says. Constantly invest, but as you see markets getting hot, invest less. And when the market collapses, invest more. The problem is most investors don't do that. So what happens is most investors buy high, and then either they can't buy low because they're not liquid, or worse still, they sell low. So they buy high, sell low. And if you're one of those people who put all of your money on the table over the last year and now suddenly have a liquidity crisis or even a cash flow crunch, then obviously we're really disappointed and sorry for you. It was never what you should have done. And hopefully you'll never do that again. And it's a very great shame. And I think the biggest shame of it is in the case of FTX, 1 million people were suckered into by a fraudulent person. In my opinion, the banks will tell us if this is true or not. They were suckered into putting all of their money into a basket that went to zero, and that would be a tragedy, of course. So Karim, the answer is, painful as it may seem, you should be allocating some capital today, and this is that moment. I actually think Warren Buffett says it quite well. He gave an example many years ago. If you like socks, this is not his example, but if you were a collector of socks, and suddenly everyone told you socks were 80% cheaper than they used to be, would you buy less socks? Would you sell your sock collection, or would you buy more socks? The answer is you should buy more socks, right? Because you're a sock collector, you love socks, and you can get 5 times as many socks for the same money. So buy socks. So anyhow, that's the long answer to your question. Dollar cost averaging is something we should always be doing. And if you aren't doing it that way, you should read up on that and do that anyhow.
Thank you. Let me just check here.
So let's see. I don't see any questions. Oh, no, here's one. Wash trading. Was that a question for us?
No, that was the previous question.
Yeah, I'm not quite sure about that. Well, so
so the other question I actually have to ask, which was prompted by Edward Brooks's question. Here's Edward's question. So in terms of investment timing, what is your view on where we are at in a worldwide/US recession then? Because some parties still don't declare that we are in a recession. And I would add to that, has various global economies actually equated into this equation that we see today with what's happening in the public markets?
Yeah, okay, thank you for that question, Karim. And I want to reiterate that we're not traders. We don't know how price gets set. We're not macroeconomists, and we're not in the business of projecting the future. We are long-term venture investors. So our whole mindset is about, can we see a future that is inevitable? Can we see powerful tailwinds driving towards that future? And can we allocate capital ahead of those tailwinds? And those, I feel very comfortable answering questions around that. Digital monies, commodities, and assets is an inevitable future. The tailwinds driving us towards that future are irresistible, and we will continue to dollar cost average placing capital in front of those tailwinds, and we're not going to stop. In fact, we will heavy up next year and the year after. We will allocate more capital because this is the time to do so. Now, if you ask me a question like, are we in recession? I would answer much the same way, which is all the evidence demonstrates that on average, some economists, some economists seem to get it right, but on average, economists don't get it better than 3 monkeys throwing darts at a dartboard. So I don't know, they don't know. And as a result, if you want to try and do, day-to-day trading on interest rate futures, you may get it right, you may get it wrong. And theoretically, and there's another part of the theory, which is the larger the market, the more liquid it is, the more efficient it is, the harder it should be to get superior returns. So why are you trading in highly liquid, well understood and efficient markets? You're not going to get a superior return because no one does on average. We focus on early and mid-stage venture because it's the highest returning asset category in the world. It's highly inefficient, and it is possible to get superior returns in a persistent way. And the best investors have persistency in venture. There's very little persistency in public investing. So again, a very long answer to your question, but the answer to your question, Karim, is I don't know.
Okay, better than the 3 monkeys for sure, because they're going to throw the dart at something. I have heard through the grapevine from several people who are our Linqto members who had the opportunity, luckily enough, to invest with you on your blockchain co-investor fund early on a couple of years ago, and that the newsletters that you send out are very informative and would help a lot of people make the correct decision on certain investment strategies that they want to make. If there are folks that would like to subscribe to that newsletter to learn more and get an understanding, is there an email address that they can use to request that?
Well, I did flash it up, blockchaincoinvestors.com. There's a lot of free resources about, the space. on that site, so you don't even have to sign up to be able to access the insights section and read newsletters or webinars. But if you actually want to join our list and get those things sent to you, you can do so. The last 30 minutes is a synthesis of our investment thesis. So, you know, frankly, you've already heard it. So as you double click and learn more, it's just going to come back to the synthesis I just shared. And then there is one question that just popped in, Kareem, from Carl. And what is our approach to evaluating specific opportunities? Now, let me say here that we believe that if you're going to be an early stage venture investor, it's extremely difficult. And the secret sauce is to have access to the best investors in the space, be able to allocate capital either into them or alongside with them in a highly diversified way. And that's what we do. So we have fund of funds that are early stage blockchain focused. We're investors in more than 40 of the top blockchain VCs in the world. And we have the most diversified portfolio as a result of blockchain holdings of anyone we believe in the world. And so that's what we do. And then every quarter, all of those 40 plus blockchain VCs report to us. We get quarterly reports. What are their holdings? What are their up rounds? What are their down rounds? What are their new rounds? And we use all of that information, which is asymmetrical information. Only we have it. No one else in the world has it, as far as we know. We use that information to selectively do direct investing, either into early stage token rounds or into mid-stage Series B, Series C equity rounds. So that's our approach. So unless you are a very, very, very good due diligence of blockchain engineering, I don't know how you can do early stage direct investing by yourself. All right. And so at minimum, you need to have a crowd of people with complementary skills. And I actually think due diligencing blockchain code would be beyond almost everyone in the world. So even if you could see what they've actually written, and they probably wouldn't show it to you unless they were going down the open source path. So in general, Carl, I would say if you're going to go into the early stage part of blockchain investing, you've got to allocate your capital to the best blockchain VCs, or at least have relationships with them so they'll tell you what the good opportunities are. And then you don't want to invest in the ones where one of them is investing. You want to invest in the situations where 3, 4, 5 of them are all investing. And that's what we do. Kareem, I think we now are out of time.
Matthew, thank you so much for your time. So much good information, great presentation. Thank you so much, and especially for everything that you do for us investors here at Linqto.
Okay, thank you so much, Kareem.
Thank you.
Bye-bye.
Bye.